Hey everybody, thank you for tuning in today. We've got Bret Nielsen back by popular demand, I guess. He was such a wealth of information, really hard. He just had so much information that we just kept rolling with it. And we started asking him about valuations, how to put a value on your retail investments. So you're going to want to stay tuned and really hear what he had to say because it's very interesting. Everybody, thank you for tuning in today. I've asked Bret Nielsen, he's an adjunct professor at USC, to come in and kind of walk us through how to value retail property. So, Bret, thank you for coming in today.
Thanks for having me.
I'm going to we've got a lot of first-time investors that watch this, so really want to tell them how you would put value on a retail asset that they're thinking about buying. So.
Well, I think from an investor, whether you're a beginner investor or intermediate or advanced, I think you always got to look at the credit of the tenant. Now, they're not always the case, but I always start with that. Is it a good credit tenant? And if so, that's obviously going to ensure hopefully longevity. Now, the other component, the flip side of it is if it's not a healthy tenant, but you're looking at a property that's got a lease with that, I'll call it an unhealthy tenant, that's got a very below market rent, I look at that as opportunity. Because if I look at this tenant that may be struggling, even though they have a lease in place, and maybe a long-term lease, I figure if they're not maybe going to be around for the long haul, I can then take back that lease, take back that obviously space, now all of a sudden lease it out to a tenant that's going to pay me a market rent, and all of a sudden I've got that arbitrage. And even if cap rates were to stay the same, which I believe cap rates are still going to remain strong, because as opposed to putting money in the money market where you're actually earning less than 1%, I think cap rates are still going to be there. So just strictly on a cap rate play alone, looking at market rents is a way to create value. Now the flip side of it is obviously if you've got short-term leases in there that obviously are above market, that's something to be concerned about, because you don't want that tenant to leave or renegotiate you, and then all of a sudden what you had an asset with an NOI up here, and now all of a sudden when they want to renew and they bring you down here, your return just got obviously sacrificed in that regard. So those are the main things I look at.
Now, do you, as an investor, do you like more regional tenants, or do you like the national credit tenants? It depends, I guess, on the asset.
It depends if they could be strong regional, and if they're actually known in that area or that region or that community that have been around for a long time. Credit is not going to really mean as much to me, because I've known they've been around for a long time. If it's still in the family, it's family run, the controlling interests or the controlling parties are still in play, I'm not as concerned about it as much. Obviously prefer to have nice credit tenants, especially if I'm going to finance it, because when I go to the bank's going to want credit. They're going to want to see who's standing behind that lease from a credit standpoint, without any emotion or without anything involved. That's the only thing they're going to look at. It's going to be very black and white. For me, I look at both.
Okay. Now, let's say you've got a nice little strip center. What kind of, let's say it's in Wyoming or Nebraska. We go to Nebraska. I like Nebraska. Lots of family there. Traffic count. What kind of power do you put in that?
You mean actually cars traffic, or
cars
actually
traffic.
Pedestrian cars? It depends on the type of uses. Now let's break it down where you touched on a strip center.
Right.
I believe, if I own a strip center, I would want service.
Right.
Why? Because Amazon's not going to touch service, right? You're not going to go to Amazon to get your hair cut, your cleaning, yet. And so there's things that they're not going to touch. So with that said, I'm obviously going to want to look at that. But because of the service, you're going to want high pedestrian counts and obviously high vehicular, because it's going to obviously be seen, it's going to catch your eye, and you're going to go there. But then you got to look at not only obviously the traffic counts, but also the quick and the easy in and out. So I looked at somebody a long time ago. There was a Starbucks on one side and a Coffee Bean on the other. And the Starbucks did an amazing business, and Coffee Bean basically, they basically failed. But it's because the way that the ingress and egress going into the Coffee Bean, and it was in the opposite direction of actually in the morning people going to work, that they couldn't actually turn over to get to the Coffee Bean, even if they preferred Coffee Bean. So those are little things that people got to look at as well. Not so much the general location, but the quick, ingress and egress, and also the congestion of that parking lot that it obviously possesses itself.
Now, do you have a rule of thumb on what kind of tenants you put, or the tenant mix that you put in? Or you just kind of, as they come, you look at them and weigh that?
I do, because if in any center that I would personally look at, I'd want
Right.
food.
Okay.
And I'm a big fan of daily needs, and obviously the service. I mean, if I had a choice of a preference, I'd want a grocery anchored center.
Right.
And the reason being is because you've got a daily needs there, you've got multiple trips, especially if it's in a high family area. You may be coming there 2 to 3 times a week. Obviously your service is you're gonna have the cross traffic, and there's gonna be very synergistic, but those are gonna survive. When we had the downturn in 08 and 09, those centers survived.
Okay.
And the reason being, sales may have dropped, but the good thing is the grocery stores, you didn't really see any hiccup at all, because people still have to eat. What you also found a surge during that time was fast casual. People weren't going to expensive restaurants anymore. They were going to fast casual, and there comes into the whole comment, which I mentioned earlier, was the fact that healthier choices, better quality, affordable prices. They're going to go to those and make it feel like they're getting good quality food at a good value, and not go to a high price expensive meal, because they can do it on more frequency for less money.
Wow. Wow, that was a lot of information. Thank you very much. Anything else that you think that our viewers should really take into as they're assessing their value on their retail assets?
I think if you look at it, besides just buying an existing asset, which is obviously much different than doing a development. If you're going to do a development, you want to get in early. You know what? Look at that single store. Look at that single location down a great street. It may be not developed yet, but it may be on the tertiary of something happening. If you can see a movement occurring, none of us have a crystal ball, but there are areas around the city of Los Angeles, like Silver Lake, it's exploded. Echo Park is changing. Fairfax has changed so much. Whereas if you can have the foresight to actually see that, even though it's hard to do sometimes, but even just buying one little storefront could make a big difference in re-tenanting it. You can always start with that. That's what I always look at.
How do you go out and find those pockets that are turning? Just by watching the local real estate market, going out and talking to agents, or how do you find it?
All of the above. I think if you can also see, if you see a national going into an area, I look at that they're probably smarter than me, and they've probably done their due diligence. They may know something that we don't, or they may just have that foresight.
Right.
So all of a sudden, when you see somebody jump into an area like that's a national, it gives it credibility, and then it takes a while to build off of that. Venice, you go down to Venice and see Abbot Kinney. I remember 20 years ago, Abbot Kinney, except for one restaurant at the time, which was established, there was nothing really there. And all of a sudden, one at a time, it started to progress. And next thing you know, it's a hot street, and rents went through the ceiling, and all of a sudden, a lot of people created a lot of value.
Yeah.
But I think it's done very organically. I don't think you can put your finger on it, but I think it's just done organically.
Thank you for tuning in again. Bret, I learned a lot from him. He's just how to put a value on a retail asset. It really, it comes down to everything that he said. The guy's been doing it for a lot of years, so really pay attention. If you have any other questions you want us to ask Bret, get us in the comments section. And while you're there, please subscribe and like this video, and tune in again next week. Thank you.